So in the last lesson, we established a non-negotiable truth. Price only moves when liquidity is consumed or removed. In this lesson, we're going to formalize how that happens by breaking the auction into two mechanical components. There are only two types of orders in the market. Every participant is using one of them at all times. We have market orders and limit orders. Understanding the difference between these two is mandatory before you can read order flow correctly. So let's start with market orders. Market orders are aggressive. They demand immediate execution at the best available price. When you buy with a market order, you're not choosing a price, you're accepting whatever liquidity exists on the ask. And when you sell with a market order, you are accepting whatever liquidity exists on the bid. Market orders represent aggressive urgency in the market. They're requests for execution now. But here's the critical point. Market orders do not move price by themselves. They only interact with liquidity. Now let's talk about limit orders. Limit orders are passive control in the market. They sit in the order book waiting to be executed at a specific price. They do not chase price. They do not demand immediacy. Limit orders represent control. They decide whether business is allowed to happen at that price. So when price is stable, it is because limit orders are absorbing market orders. When price stalls out, it is because limit orders are still present. When price moves, it is because limit orders were removed, either traded through or pulled. Now think of it like this, because this is the most important relationship in the auction. Market orders are fuel and limit orders are walls. Fuel can push price, but walls control whether price continues to move or stop. Price movement only occurs when fuel meets walls that are weak, absent, or walls that are pulling. This is why aggression alone is insufficient. You can have heavy buying pressure, which is large market buys, and see no price movement. Why? Because limit sellers are absorbing that aggression. They are willing to do business at that price. As long as that willingness exists, price cannot move higher. And this is also why thin markets can move violently. It's not because participation is necessarily very strong. It's because there's no liquidity resisting movement. And you can clearly see this when you compare different markets or different assets. For example, NQ versus ES, or the NASDAQ versus S&P 500. NQ trades with much thinner order books arresting liquidity than ES. So when liquidity pulls or gets consumed, price has far less resistance. That's why NQ tends to move faster, it overshoots levels, and behaves more erratically, while ES often looks smoother and more controlled. The difference isn't emotion or volatility, it's liquidity depth. So when traders say buyers are in control here or sellers are dominating, those statements are incomplete. Control does not belong to the side that is most active. Remember, control belongs to the side that is passive. They are providing or withholding liquidity. Aggression shows intent, where liquidity decides outcomes. So later in this course, you'll see that not all aggressive orders come from traders choosing to enter. Some come from forced participants like stops and liquidations, but mechanically, the market does not distinguish between them. Another common misconception is that large size equals influence, but it doesn't. Large limit orders can be fake, and large market orders can fail. Size without context is meaningless. Only the interaction between market orders and limit orders produces information. So at this point, you should be able to answer these questions clearly. Who is acting? Who is waiting? And where is liquidity present? And why is price allowed or not allowed to move? If you cannot answer those questions, then any interpretation you make later will be guesswork. So in the next lesson, we're going to take this understanding one step further by reframing liquidity itself, not as a line or a level, but as a finite resource that large participants must acquire to operate.